welcome to TheoTrade. This is Don Kaufman. In this video, we're going to be talking a bit about dividend risk that exists for those of you that do trade options. Now, your dividend risk can impact you in a number of different ways, but the first thing that we got to talk about is what is the risk, how to identify the risk, and then really how to kind of circumnavigate some of that dividend risk. So what I've done is I'm here on the thinkorswim trading application. I've gone under the trade tab, all products, typed in MO, the Altria group. The reason I am looking at the Altria group, it happens to have a dividend up and coming, and to see that on the thinkorswim trading application right next to last up here, just go ahead and click on that. All right, opens up PE, earnings per share. There's the dividend, 56 cents, paid out quarterly, and the ex-dividend date, first and foremost. Okay, there's all kinds of, quote unquote dates associated with dividends. You're like, this is the date the dividend is going to be paid. This is the date that the board has announced the dividend. Okay, whatever. All the dates that are out there. I have to be on the date of record. If I'm not on record, do I get paid the dividend? The date that matters to you, if you're trading options, is the ex-dividend date. And that's why it's on the thinkorswim trading application. The ex-dividend date is what matters, and that is December 22nd, 2015. It doesn't matter when you're watching this. This is just one of the, the MO dividends. And you can see it in the charts as well. There it is in all of its glory. It's warning you. It's coming. Okay. Recognize the dividend date. Now, we've identified that's the date that matters. Why is that the date, though, that matters? Because that's ultimately the date, okay, unto which the stock will trade with the dividend priced in. Okay, what that basically means is come, December 22nd, 2015, that's when this 56-cent dividend will be priced into the stock. And again, not all the time, but most of the time when a stock opens on the ex-dividend date, it's going to be down in the amount of the dividend. Okay, it doesn't always mean that, because maybe this particular stock's a bit more volatile. Well, this one's not, but maybe the stock's more volatile and the stock rallies up a buck. If the stock is up a buck, again, it's going to take a 56.5-cent chunk out of that underlying. Again, neither here nor there. The important part is that you understand the ex-dividend date. That's the date that you have to focus on if you're in an options position. Now let's get to the options side of it. I open up, in this case, the 3-day options. Now, it is not only the 3-day options that could be impacted here. You could have 3-day options or 10-day options or even 18-day options. What are we looking for? Okay, and where lies my risk? Okay, specifically, the risk that you assume in carrying a position in options through the ex-dividend date, okay, that risk exists in calls. Again, that risk exists in calls. Now, there's always risk if you've sold puts, right? If you've sold puts, somebody can put you stock, roughly speaking, at any time. But if you have sold calls, okay, if you have sold calls in this particular case, right, let's assume that you sold some calls. If you sell those calls, okay, what can happen? Well, somebody has the right to call stock away from you. You're like, okay, do you own stock? Doesn't matter, neither here nor there. You could be in a covered call position where you own the stock and you've sold a call. But if you've sold a call, somebody has the right to call the stock away from you. Let's say, for example, you sold the 56 call. Okay, I'll freeze the screen right here, right now. Just highlight right here. Let's just assume that you sold this guy right here, right now, the 56, okay? And because you've sold it, somebody has the right to take stock from you at what? 56. Would they do that by the ex-dividend date? Well, why would they want to call the stock from you? They might want to call the stock from you because they'll get paid, what? The 56.5 cents. Now, wouldn't it make sense if you own a call, if you just owned the 56 call, what does that give you to do? It gives you the right to buy the stock at 56. Do you want to buy the stock at 56? Okay, and then, well, maybe. Well, you do if it's going to pay out what? A 56-cent dividend, because just owning the call, just owning this call, it doesn't give you the right to any dividend. What do you have to do? You have to exercise the call. You have to go, I want the stock at 56. And if you actually get the stock at 56, then and only then do you get paid, okay, the 56-cent dividend. But here lies the issue. Is it worthwhile? If you owned this call, is it worthwhile exercising it? Now, you need to look at this from a couple of different scenarios, because you got to realize you may have sold a call, all right? And when you sell a call, you got to think to yourself, is somebody going to call this stock away from me? Because is that somebody, do they want to get paid the 56 cents? And the rationale, what is the rationale? Okay, why would they call the stock versus not call the stock? And that's exactly what we're going to focus on here. And in essence, to do that, blank the screen for a moment. Okay, we're going to look at the 57.5. We're going to look at both the calls and we're going to look at the puts. Now, the reason I bring up both calls and puts, and again, everything on the left side of your screen is calls, everything on the right side of your screen is puts. Look at the pricing on here. The stock is currently sitting at 57.34. Okay, that means these puts, they are quote unquote in the money by about 15 cents. Did you notice though that the puts, they're trading for like, the mid price in these things is about 85 cents. They're trading for about 85 cents. What? These calls, what are they trading for? Let's just round it. They're trading for about 20 cents. Why are the puts, okay, in this case, pricing so much more than the calls? And the reason is the dividend, okay? They're already pricing in the dividend over there. What that ultimately means is if you look, all right, at this put-call relationship over here, and there's actually a relationship called the put-call parity. So if you looked at the put-call relationship, you're going to see the puts are already trading as if the dividend has taken place. Like, realize that options are going to price everything in, okay? And even if you look at the 57 calls versus the 57 puts, now granted, the 57 calls, they're in the money, okay, by 33 cents. And yet the puts are still trading for more. You're like, okay, so how does that impact me, sir? Okay, your risk when you have sold calls is any option that is at the money or in the money, okay, could in fact be assigned, even if it's part of a spread. Like, you may have bought the 56 calls, but you sold, for instance, the 57 calls. Well, these 57 calls, they may get assigned. And if they get assigned, tomorrow morning, you're going to wake up and find out that you're the, what? Okay, you're short stock at 57. Yes, you have the right to buy the stock at 56 and you're still hedged. But that short stock position at 57 forces you to do what? You have to end up paying the dividend. So again, where does the risk really lie? If you've sold options, okay, the risk lies at the money or in the money calls. At the money or in the money calls that you are short. You need to consider rolling those options out. Now, rolling them out to where? To a future expiration. Here's where things are going to get kind of dicey in this video in explaining this. How do you know, okay? Or how do you have a good idea that you're going to be assigned on a call? For example, this 57 call, okay? If you are short that 57 call, all right, so this 57 call right here, if you sold that 57 call, you want to know something, right? You want to know, am I going to be assigned on that 57 call? And my answer to you is, okay, it's very, very close. it's very, very likely that you are going to be assigned on the 57 call. Okay? Another example, and you're going to ask, oh, why? Why? Well, we're coming to that. Maybe, again, we'll go right back to our original example. Maybe you're short the 56 call. Maybe you're short these 56 calls and you're wondering, am I going to be assigned? Here's one of the easiest ways, okay, to kind of figure out if you're going to be assigned on the 56 call, the one that you have sold to open. What do? Take the call that you are short. Look at the opposing put. The opposing put, okay, because what that's doing is it's looking at this put-call parity. Look at the put and say, is this put greater or less than the amount of the dividend? You're like, okay, is it greater than or less than the amount of the dividend? Well, the put, in this case, is a lot less than 56 cents. That means this call has a high likelihood of being assigned. And you're like, well, why? Has to do with time value left in these 3-day options. But don't stop there. You can go even further out in time. We could even go out to what? Let's go out to these 10-day options. Do you realize that not just the shortest duration options can be assigned early? We can look at the 56s. All right, here's the 56 calls. And again, if you were short these 56 calls, you're thinking, oh, I got plenty of time, man. There's 10 days left on. I mean, what are you worried about? Yeah. And you look at the price of the put versus the dividend. And if the price of the put is trading for less than the dividend, assignment is highly likely. We're talking over a 90% chance that you're going to be assigned on these short calls. Go even further out in time. Let's go 18 days out. Again, in the money calls that you're short have a high likelihood of being assigned. Let's open up a few more strikes over here just to prove a little bit of a point. Even options that are like right at the inflection point, in this case, it's right in this neighborhood here. Okay, here's one where if you look at the 55.50, okay, calls, you're kind of wondering, am I going to be, all right, assigned on those 55.5 calls? And you look at the dividend amount, it's 56 cents, okay, and then you do what? Compare that to the mid price of the put, and the answer is, on this one, it's too close to call. This is literally too close to call. First of all, the stock is still moving. The day ain't over. This is too close to call. And what you'd want to do is you have to take this option. You'd have to buy it back and sell one further out in time to avoid the assignment over here. Listen, with dividends, knowing is half the battle. And I know that some of this is the first time you've gone through it. It's a little bit confusing. But you've got to realize this ex-dividend date, you have to either trade out of or roll your position prior to the ex-dividend date. You can't wait until the 22nd. You got to roll it or close it on the 21st, okay, or prior to that time. Remember, when dividends and options, it's all about the ex-dividend date. Thanks a lot, everybody, for joining us here at Theo.